Okay, perfect. We're going to start the webinar. So let me share the presentation. So thank you everyone for taking the time this morning to join Leyton in presenting you kind of an overview of the clean economy tax incentives that were recently announced by the government. So today, myself, Dorian Kartalovski, I'm the Senior Director of Innovation at Leyton. I'm going to be joined by Nicholas Garcia, who is a Senior Manager as well at Leyton. We're going to give you
everyone.
Of the different incentives that are currently open or that will be open soon for Canadian corporations. So we've split that presentation into 5 different sections. So to start off, I'm just going to give you a brief overview and introduction of the zero net emission strategy from the government. We will then focus on 2 of the 4 tax incentives, which are the clean technology tax credit, as well as the carbon capture, utilization, and storage tax credit. And then we'll finish up with some closing remarks or important points to note about those programs and strategies. And then there will be a Q&A session at the end. So you should be able, all of you guys, to see on your screen a chat section where you can ask your question in writing. So we will take note of all of your questions and we will address them at the end of the presentation. So to start off, to give you a quick introduction, so the Government of Canada has officially launched the first clean economy investment tax credits. And then this is a discussion that has been ongoing since the end of 2022 during the fall economy statement. And recently on June 21st, 2024, the passing into law of the first 4 clean economy investment tax credits took effect. So these 4 tax credits, the Clean Technology Investment Tax Credit, the Carbon Capture, Utilization and Storage Tax Credit, the Clean Technology Manufacturing Tax Credit, and then the Clean Hydrogen Tax Credit compose the what the government calls the Clean Economy Investment Tax Credits together. So together, the government estimates that those tax credits will represent roughly $93 billion in federal incentives by 2034-35. And this is aligned with the net zero future strategy from the current government and will play an essential role in attracting investments, supporting Canadian innovation, creating jobs, as well as driving Canada's economy toward the net zero goal by 2050. So just to give you a quick, very high level overview of each of the 4 credits that are currently in place or approved, the Clean Technology Tax Credit has an objective to provide support to qualifying taxpayers who are investing capital in specified clean technologies in Canada. The second one, the Carbon Capture Tax Credit, provides support to taxable Canadian corporations that incur eligible expenditures for qualified CCUS projects and is available to a broad range of CCUS applications and projects across different industrial sectors. The third one, the Clean Technology Manufacturing Credit, is here to support Canadian companies that are manufacturing or processing clean technologies through the investment in new machinery and equipment that is used to manufacture or process clean key technologies, as well as extract, process, and recycle key critical minerals. And then the fourth one, the Clean Hydrogen Tax Credit, provides a refundable credit for investments in projects that produce hydrogen. Projects that produce the cleanest hydrogen will be receiving the highest level of support. And it will also include support for equipment that is needed to convert hydrogen into ammonia in order to transport hydrogen. Okay? So what's important to know is even though there are currently 4 credits as part of this global incentive, the royal assent that took effect through Bill C-59 on June 21st only right now allows eligible businesses to apply for the 2 of those 4 credits, the clean technology and the carbon capture, which are the 2 credits that we'll be focusing the presentation on. Further information on the 2 remaining credits, so the manufacturing and the hydrogen, will be released over the coming months. So we should expect to see some update on when the application will be allowed for Canadian corporation and a more detailed calculation on how the credit is being used and utilized. So if we focus on the first 2 credits, combined, it is expected that those programs will provide around $11.4 billion in support through 2027 to 2028. So if we focus first on the Clean Technology Tax Credit, which is the main credit through that incentive. So the clean technology, or CT, is a refundable tax credit for capital that is invested in the adoption and operation of new clean technologies property in Canada from March 28, 2023, all the way up to December 31st, 2034. Okay, so the program is administered through two different government bodies. You have the Canada Revenue Agency that provides the ability to claim the credit on the corporate income tax return or the trust return. And then Natural Resource Canada is here to provide engineering and scientific guidance on what is a clean technology property. The rates for those credits will vary based on different factors that we'll dig into a bit later on, but you can claim up to 30% of the capital cost of the clean technology property that is acquired if it becomes available for use between March 28, 2023 to December 31st, 2033. And then past that date, from January 1st, 2024, you can get up to 15% for a property that is acquired and becomes available. So who can claim the clean technology tax credit? So that tax credit is available to two types of entities. You can claim the credit if you are a taxable Canadian corporation. That includes also a Canadian corporation that is a member of a partnership. Or you can also claim the credit if you are a mutual fund trust that is a real estate investment trust. Okay. It is important to note that those four credits are not the only credit that exists currently in Canada for anything related to clean energy or zero net emission. There is, for instance, a tax credit that exists for companies located in the Atlantic provinces that is called the Atlantic Investment Tax Credit. And a company could potentially claim several tax credits. However, in general, you can only claim one of the credits for the same eligible property. So whether you are already leveraging the Atlantic Investment Tax Credits or whether you're looking to leverage several of those new federal tax credits, you can do so, but you will always have to look at for which eligible property you want to claim which credit. You can have several properties within the same clean project. But then you will have to identify for each property which credit is the more advantageous for your company based on the requirement of each credit. So for the clean technology tax credit, what is a qualifiable property? The property, which you can think of as an equipment, is an equipment that is situated in and intended for use exclusively in Canada. And it cannot be an equipment that has been previously used or acquired for use or lease for any purpose before the acquisition by the taxpayer, the company who's looking to claim the tax credit. So that means that you can only get the credit on new equipment that you either buy or lease, and you must exclusively use that equipment in Canada. The government, CRA, has issued a list of different categories under which a property could be an eligible clean technology property, and there are several different categories for so. The first one is an equipment that is used to generate electricity from solar, wind, and water energy. The second category is any stationary electricity storage equipment that does not use any fossil fuel in operation, for instance, any batteries or pumped hydroelectric storage. The third equipment would be an active solar heating equipment, air source heat pumps, and ground source heat pumps. You also have non-road zero emission vehicles related to charging and refueling equipment that is used primarily for such vehicles. You can also claim the credit if you are acquiring equipment that is used exclusively for the purpose of generating electrical energy or heat energy solely from geothermal energy. And then you can also buy concentrated solar energy equipment or small modular nuclear reactors. So these categories are broad categories, and they tend to fall under class 43.1 and 43.2 of any property equipment acquisition. And Natural Resources Canada has also issued a technical guidance report on whether the property belongs to those classes. At the end of the presentation, we've put a link for you if you want to access that report. It's around 200 pages long, and it would give detail of each of the categories that are listed above and how they would fit within the 43.1 and 43.2 category. So if you are looking to acquire an equipment that would fall into those categories, how do you claim the credit? As I mentioned above, the credit rate is based on the time at which the equipment will become available for use, and that rate varies from 15% to 30%. Now, those percentages are what we call regular tax credit rate, but you can also get a reduced tax credit rate. which is essentially 10 percentage points less than the regular rate. And this is based on whether the company elect to meet certain labor requirements for prevailing wages and apprenticeships to benefit from those enhanced rates. Okay, so depending on whether you decide to elect the labor requirement or not, the credit will be impacted. So we need to spend a bit of time into explaining what labor requirements are and how do you determine whether or not you can get the 30% or for instance, the 20% rate if you decide to use the equipment before December 31st, 2033. Okay, so labor requirement is split into two different sections. You have prevailing wage requirement and apprenticeship. So we'll go first through the labor requirement and the prevailing wage requirement. So initially, when information were received about these credits and those credits, there was no information about what prevailing wage meant. And it wasn't sure whether it simply meant that workers are paid fairly, and there was no benchmark available for a company to kind of determine whether the wage that was paid to the people working on the project were paid fairly. So through that new law that was put in place, they have clarified what the prevailing wage means and how you're compensating workers. So prevailing wage requirements are considered to be met when you're compensating covered workers at a designated work site in respect to their work on the preparation or installation of the specified property in accordance with an eligible collective agreement that applies to the worker. So if you are working with employees under a collective agreement, then you most likely meet the labor requirement for prevailing wage because all of the wage are guided through a collective agreement. If there is no collective agreement, it means that you don't necessarily have some rules to follow about the wages that you're compensating your employee, but you can still be considered to be eligible through the prevailing wage requirement if you can show that you are attempting to be as fair as possible. So it means that the compensation that you give your employee must be at least equal to the amount of wage that you would have paid if the paid was decided under a collective agreement, and it needs to be aligned with a collective agreement that you found that is as close as possible to your worker experience level, the task that they're performing, as well as the location that they're doing so. And this must be calculated on an hourly basis. Okay, so if you're working through a collective agreement, then there is no worry to have about whether or not you meet the prevailing wage. But if you don't work with a collective agreement, then it is the responsibility of the claimant to identify a corresponding collective agreement that kind of fits the purpose and the workers that are working on the project to be able to showcase that you are attempting to be as fair as possible. So CRA has also given a definition of what a collective agreement is, which is the sentence that I've highlighted in bold. I'm going to read it to you. It's quite complicated, but a collective agreement, it's a project labor agreement that is established with a trade union in accordance with applicable provincial law that covers the work associated with the investments eligible for specified tax credit, and that provides for wages and benefits for covered workers in a given trade that are at least equal to the regular wages and benefits provided for covered worker in the most recent multi-employer collective bargaining agreement negotiated with a trade union that is an affiliate of the Canadian Board Trade Union Association that have applied had the project labor agreement not been in place. So if you are an employer looking to potentially meet the labor requirement and you do not work with a collective agreement, I've provided here the link to the Canada's Building Trade Association, where you can find the most recent labor agreement in place. They are publicly available for you to be able to identify what most closely fit with the situation that you are enhanced with. In Quebec, it's a different way of working. So the collective agreement is defined as a collective agreement that is negotiated under, in accordance with applicable provincial law. So you will need to go through the Quebec government website in order to identify such collective agreements. So it's not just about having an agreement in place or being able to showcase. There are additional requirements as well in order for you to be able to elect that you've met the labor requirement. You must communicate to your employee that you are actually electing the prevailing wage requirement. So that means that you need, at a designated work site, you need to tell your employees that that work site is subject to prevailing wage requirements in relation to the covered workers. And you also need to communicate to your employees how they can report to the CRA any failures to pay prevailing wages. The information must be communicated by electronic means or in a notice or a poster in a manner that is readily visible to and accessible by covered workers, and in a language format that is plain, that explains what it means for the worker. Okay, so if you are doing so and you consider that you're doing so, then you need to ask yourself a list of questions to determine whether or not the requirements are met. And CRA has provided a non-exhaustive list of different factors that you need to consider to be able for you to adjust and identify whether or not you're meeting those requirements. So you need to ask yourself how the wages are calculated for the covered worker, okay? How the value of the benefit paid to the covered worker is determined, what eligible collective agreements you have used and why, and in those agreements, the names of the eligible collective agreements that were obtained, list all of the eligible agreements that were used to determine the compensation, including the regular wages and the benefits. And you need to provide reasoning as to why certain agreements were not used or certain schedule within these agreements were or were not used, okay? If you're working with a collective agreement that has expired, then the wages and benefits must be adjusted by the average consumer price index for each calendar year that begins after the expiration of the agreement for it to remain non-expired at the time of the application. You also need to ask yourself what efforts you made to ensure that any subcontractors was aware of the labor requirements and any subcontractors of the subcontractors as well, okay? You also need to ask yourself whether a project labor agreement that covers the work associated with the investment tax credit application was signed and how you communicated that information to your workers. Now, because in the fall statement of 2023, all of that information was not available, some projects started before that date. And so CRA has kind of ruled about what happens if you started an investment project, acquired some equipment, because you can go as far back as March 2023, but you were not aware about the labor requirement decision. So CRA has said that as long as you have made a review today to ensure that those requirements were met at the time of November 28, 2023, even if they were not met before that date, you would still be considered to be to have met those labor requirements. So this is one of the two prevailing wage requirements, is one of the two labor requirements in order to benefit from the enhanced rate. The second one is apprenticeship requirements. So if you're working with apprentices that are working on the installation or the preparation of the equipment, then the apprenticeship requirements are met by making reasonable efforts to ensure that apprentices work at least 10% of the total hours through the project of the incentive claimant on the preparation or installation of the specified property. So that means that when you look at all of the people that you've employed in order to install and prepare that equipment, you must ensure that if you are working with apprentices, at least 10% of the hours were performed by apprentices. If there is an applicable law or collective agreement that you work with that restricts the percentage of apprentices below 10%, you could still be considered to be eligible, or you can still be considered to have met those apprenticeship requirements, but you need to make efforts to come as close as possible to meeting the 10% without breaking the other applicable rules. So to give you an example, if you're acquiring a clean technology equipment and you required 11 electricians to complete the installation, okay? Under your collective agreement, at most, it says that for every 10 journey person on site, you cannot have more than one apprentice. Essentially, the collective agreement prevents you from having more than one apprentice because you have 11 electricians, but you can only have one apprentice for 10 people. So because you only have one apprentice for 11 people, you only are dedicating 9% of the time for an apprentice. So you're not meeting the 10%, but because you've been restricted by your collective agreement, the employer would still be considered to be compliant with the apprenticeship requirement because you have followed your collective agreement rule in that instance. Okay. Now, for apprentices, if you're not able to meet the 10% requirement, you, as mentioned, you need to make effort in order to be as close as possible to the 10%. CRA has also outlined what they consider to be reasonable effort, and you need to follow those 4 guidelines at least every 4 months. So you need to advertise seeking sufficient apprentices to perform those hours every 4 months. You need to communicate on a regular basis with the trade union and at least one secondary school or post-secondary educational institution for the purpose of facilitating the hiring of the apprentice position described in the job advertisement. You also need to receive a confirmation in writing from the trade union that the trade union has provided as many apprentices as reasonably possible for work at the designated work site during the installation year, unless the trade union fails to respond to your request within 5 business days. And you also need to review and consider all applicants received through the trade union in response to the advertisement for apprenticeship opportunities and take reasonable steps to ensure that other applicants are reviewed and duly considered. So if you're not able to meet the 10%, you still need to showcase that there has been reasonable effort every 4 months to be able to get more apprentices working on your project. Now, same as for the wage requirements, to determine whether you have met the apprentice requirement, there are different factors, but you need to essentially provide a calculation on how you've met the 10%. And if you're not able to meet the 10%, you need to provide supporting documentation to prove the restrictions that were applied to you to be able to not be able to get to the 10%. Similarly, as for the wage requirement, if the projects were under construction prior to November 28, 2023, we need to show that a review was made to verify that apprenticeship requirements were met starting from November 28, 2023. So all of those requirements are made for the purpose of being able to claim an enhanced credit rate. If you're not able to meet those requirements, or if you do not wish to elect that you've met the labor requirement, you can still claim the tax credit, but at a reduced rate. Now, there are consequences through CRA for non-compliance. So if you do wish to select that you've elected, if you do wish to elect that you've met the labor requirement, but you actually have not done it, there are several penalties that CRA will put in place if it's not done properly. So for prevailing wages, if you selected that you've met the prevailing wages requirement, but you actually in fact have not, in 2023, you will be liable to pay $20 per day for each day in the installation taxation year for each covered work that was not paid the prevailing wage. So they will calculate each day where you said that you have met the requirement, and if you have not, they will do $20 penalty per day per worker. And then that $20 is adjusted with inflation after calendar year 2023. You can also be liable to pay a corrective measure in a form of a top-up amount for each covered worker, which would be the difference between the prevailing wage against what you've actually paid plus interest. When you receive that notice from the minister, you have 1 year to pay the difference of the prevailing wage. And then if you do not pay within 1 year after receipt of the notification, there is also a second penalty of 120% of that unpaid amount that you receive through your notice of receipt from the minister. Okay. So that's for the prevailing wages. For the apprenticeship, it's a similar calculation, but because it's based on a 10% hour basis, then you will also be liable to pay a dollar amount that is multiplied by the difference between the total hours of labor that were required to meet the 10% against the actual number of hours performed by the apprentices. And that amount is $50 in 2023 and is adjusted with inflation for calendar year after 2023. So if you say that you've met the 10% requirement, but indeed you've only done 9%, they will calculate how many hours was required to meet the 10%, do $50 per hour, and then adjust with inflation for each calendar year after 2023. If you are found to not be compliant, even though you've elected that you were, after you've paid all of those penalties, you will still be entitled to claim the credit at the regular rate, so the enhanced rate of 30%. However, there is one condition where you would not be able to do that, and that is if CRA found that there was a gross negligence that was done on the application. If they found that there is gross negligence, you will be disentitled to the regular tax credit, and you will only be able to get the credit at the reduced rate. And on top of that, you may be liable to pay a penalty on top, which is equal to 50% of the difference between the amount of credits that were claimed at the regular credit versus the amount that you are entitled to at the reduced rate. So if we take an example that through the tax credit, you've claimed at the regular rate $500,000 at 30%, but the CRA finds that there was gross negligence and you can only claim that at a reduced rate of 20%, and maybe let's say that's $250,000. The difference is $250,000, so the penalty would be half of that amount, which is $175,000. So it is important that for any company that wish to elect, the labor requirements are met. It is very important to go through all of the documentation to make sure that the application is solid and that there is no basis for CRA to kind of argument against that labor requirement election. So once you've acquired the equipment and whether or not you decide to meet or to elect that you've met the labor requirement, then you can claim the credits. So the credit is claimed on either the corporate tax return for a corporation or the trust tax return for a mutual fund trust. There are currently, as of today, there is no form that exists to submit the detailed calculation for the clean technology tax credit. So in the meantime, CRA has provided a guide on how the application must be done. You need to put the amount of the tax credit that you've calculated on line 155 of Schedule 31, which is part 24. And then you also need to ensure that the amount is included in the total on line 780 of the T2. Okay? Because that detail is only the final tax credit amount that you're requesting, we also need to provide additional documents to be able to show the detailed calculation. So on top of the tax return, until there's a form that exists to provide that information, we need to provide supporting documentation that explains the total tax credit calculation. And then for each clean technology property, we need to include the capital cost allowance class, the property type, the cost of the property, the province or territory where the property is located, whether the labor requirement election is met or not, and if it is, the attestation that goes with it, and any potential recapture of the tax credit, which I'm going to explain in the next slide. In order to submit all of those documents, the CRA has a new service on their portal, which is called Attach a Doc service. So when you submit a tax return, you will be able to submit additional documents as well through the portal. If the return is submitted electronically through a tax software, because it's not submitted through CRA, it's okay. You still will have 24 hours after the T2 is received through your tax software to go on the CRA portal and submit those documents as well and link them to the T2 that is returned. Past 24 hours, it will not be possible for you to submit those additional documents. And so you will have to call CRA to request potentially another way of you for submitting those documents. Now, earlier, I talked about the recapture. So first, let's talk about the filing requirements. So how long do you have to submit that claim? The tax credit claim must be submitting by the filing due date of your corporation income tax return. So that is 6 months after the end of your fiscal year. But CRA will also accept late filing of the appropriate information if it's filed no later than 1 year after the filing due date. So in a sense, you have 18 months after the end of your fiscal year to provide an amended tax return in order to claim the ITC. Okay? If the claim is accepted as filed, you will be notified on your notice of assessment or reassessment the amount of tax credit that is approved. CRA can also audit the applications. If they do audit, then you will receive a letter that requests additional information on the tax credit so that they can verify whether the calculation was done correctly or not. Now, earlier, I talked about potential recapture of the ITC. It is important to note that the ITC that you will potentially get can be recaptured by CRA in a taxation year that is either the current year or the preceding 10 calendar year. So that means they can go back up to 10 years in the past to verify whether you're still entitled for the tax credit. Earlier, I mentioned that for that clean technology tax credit, the property must be exclusively used in Canada. And so that is one of the requirements. If the property was exported from Canada at some point, the CRA allows themselves to do a recapture on your credit. So if you buy an equipment now, you say that they will be used essentially exclusively in Canada, and you will get the tax credit in 5 years. If you sell that and you export it from Canada, you will need to reimburse that tax credit. If you don't, and CRA decides to audit, they can recapture the credit on the basis that it is not exclusively used in Canada anymore. The other two scenarios would be if your property was converted to a non-clean technology use, because it defeats the purpose of the credit, and if you decide to dispose of the clean technology. So you will need to make sure that at least for the next 10 years, you follow those rules so that there is no potential recapture on your tax credit. And so now I'm going to let Nicholas introduce you to the carbon capture, utilization, and storage tax credit.
Hi, everyone. So this is another portion of the program, which is aiming at a very specific thing, notably carbon capture, utilization, and storage, specifically for CO2. Now, this one's very, looks far into the future. So it is also a refundable tax credit, and it applies to eligible expenditures incurred for qualified projects, which will occur from January 1st, 2022 to December 31st, 2040. And this program is also administered through two government entities, namely CRA and NRCan, with CRA basically giving people the ability to claim the credit through their tax return, and then NRCan is there to evaluate the projects and then verify the properties, and also provide scientific, engineering, and technical guidance to the claimants. And there are different rates for this tax credit depending on the type of capture, or the type of activities that you're getting a tax credit on. Namely, the highest rate is for qualified capture expenditures directly from ambient air, and then a slightly lower rate for the capture of carbon from other than from directly from ambient air. So that would involve capture from industrial processes, namely. And then a lower rate for transportation, storage, or usage expenditures. Now we'll get into what those things are later on. And so what is this tax credit? So basically it's related to the acquisition of property, which is used to capture carbon dioxide emissions from the combustion of fuel or industrial processes, or again, directly from ambient air. And then also it involves expenses for transporting captured CO2, storing it, or using it in an industry. It's applicable to a variety of industries, namely concrete, plastics, and fuel, as they are some of the biggest producers of CO2. Now, for a project to be admissible, it has to involve 10% or more of the captured CO2 being used, destined to an eligible use, which are storage of carbon capture in dedicated geological storage, or the use of captured carbon for producing concrete in Canada or the USA, using a qualified process to sequester the CO2 in the concrete. I'll get into a little bit more detail about what those things are later, because I know it might not speak to you exactly. And then any other uses, including enhanced oil recovery, are not considered eligible. And so there's a bunch of different things that you can do with sequestered CO2 that don't seem to be covered yet. So it's really very specific for now, but we'll see how the program evolves in the future. So who can claim this credit? So it's very similar to the clean technology tax credit in that it's available to taxable Canadian corporations, including members of a partnership. And these corporations have to have qualified projects, which include qualified expenditures, and which were incurred from January 1st, 2022 to December 31st, 2040. And similarly to the Cleantech tax credits, there are some exclusions, namely that you can't claim multiple tax credits on the same eligible property. So you can claim multiple tax credits on the same project, but not on the same property. So a project can be composed of several properties, but for a given property, generally you can't claim multiple credits. So that's an important thing to understand about this. So what type of projects would qualify for this program? So basically a project, it's intended to support a carbon capture process by either capturing CO2, which would otherwise be released to atmosphere, for example, from an industrial process, or it can involve capturing CO2 directly from ambient air. So that would be like a dedicated facility specifically for that. It can also involve transporting captured carbon, storing or using the captured carbon. And in terms of those different categories, so for qualified capture expenditures, so basically it's eligible to the proportion of the quantity of captured CO2 destined for storage or use in eligible uses. So for example, if you capture 100 tons of CO2, but only 50% of it is destined to an eligible use, either storage or use in production of concrete, then only 50% of your capture expenditures would be eligible for this credit. In the same way for transportation expenses, they're eligible in proportion to the quantity of CO2 destined for an eligible use. So in terms of usage expenditures, for now, the program is really only aiming at the acquisition of property, which is expected to support the use of captured CO2 in the production of concrete in the Canada or USA using a qualified storage process. So basically, I looked into it, and what this implies is that apparently you can use CO2 when you pour concrete. And basically, you deliberately expose the wet concrete to CO2, and it gets absorbed into the concrete matrix, and apparently also improves its mechanical processes. But what's interesting about this is more at a user level. It's not necessarily for producers of concrete. So any construction company that uses concrete technically could be eligible to this. Now, these are things that remain to be seen, but it seems to be something that'd be widely applicable by anybody that actually uses concrete. And definitely they would need to get a setup which allows them to expose their concrete to CO2. But it actually seems like a pretty interesting thing, apparently, since it also improves the mechanical properties of your concrete. Now, in terms of storage, this is something very different. So you can store CO2 underground in a supercritical form. So if you store CO2 over something like 800 feet over ground, the pressures and temperatures there imply that it's already going to be in that supercritical form, which is just another state of matter. But basically, so you have to store the CO2 in these dedicated geological storage facilities, which, there's certainly specialized companies who are doing that. And so the idea here is that you don't have to do both. I mean, you do have to destine your CO2 for one of these intended uses, but I don't think you have to be the end user. So you could just give your CO2 to a company that does dedicated geological storage, and then that would make your other eligible expenditures for capture or transport admissible. And again, the information provided by CRA doesn't necessarily make all this clear, but it's the kind of thing that we can expect clarifications on as we go along in time. And also, these qualified expenditures have to be related to specific capital cost categories. So that's an important thing to note as well. So how to claim the credit. So an important thing that distinguishes this from the Cleantech tax credits is that you have to get pre-approval from NRCan for your project. So you have to first submit a project plan to them. After that, you'll get a determination from CRA because they are coordinating on this. And they'll tell you whether they consider it a single project or multiple projects. And then as part of that, you will get project evaluations from NRCan for each of these qualified projects. And so once you have those elements, you may be eligible to claim these ITCs, even retroactively, as the program starts for projects which start on January 1st, 2022. And similarly to the Cleantech tax credits, you have to be aware whether or not you meet the requirements to get the normal tax credit rate or whether you need to claim at the reduced tax credit rate. And it has a similar impact if you don't meet those requirements, where the credit rate will be reduced by 10 percentage points if you don't meet those labor and apprenticeship requirements. So how to calculate the credit. So there's two different types of credits. There's the development and the refurbishment. And without getting into that too much, development is before the process is actually operating, and then refurbishment is once it's operating. And for the development, there's definitely a consideration of your year-over-year expenses, in that the credit consists of the amount by which your cumulative development CCUS tax credit for the year exceeds your cumulative development CCUS tax credits for the preceding tax year. So there seems like there has to be a certain ramp up of expenses to actually have admissible expenses in this program. And these are all for costs which are incurred before the first day of commercial operation of the relevant qualified CCUS project. So basically before the process actually starts operating, this is where you would get the bulk of your tax credits for things like engineering, installation, commissioning. And then once your process is operating, this is where you get the refurbishment tax credit. But there is a limit to up to 10% of the total qualified CCUS expenditures incurred before the first day of operation. So there is a cap on the refurbishment tax credits. And there are also different tax credit rates depending on the type of cost you're looking at here. And then also depending on when you're claiming those types of costs in time, there's different rates where from 2031 onwards, basically all the credit rates get cut in half. Depending on the category that you're looking at. So similarly to the Cleantech tax credits, it is claimed in the tax return. And there is also no form that currently exists to actually submit the detailed calculations for the CCUS ITC. But until then, you have to input the ITC amount on line 200, similarly to the Cleantech tax credit, and that would be in part 25. And then you also have to ensure that the amount is included in the total on line 780 of the T2. And in terms of the detailed calculations, you do have to submit separate documents to CRA with your tax return. And this has to include the total CCUS ITC claim calculation. And then for each CCUS project, you have to include the following. So you have to include the cumulative CCUS development tax credit calculation, which includes the total prior year CCUS expenditures, the total current year CCUS expenditures, the ITC rate for each qualified expenditure, depending on its nature, and then the cumulative CCUS development tax credit for prior years. So this also has to include the identification of details of any property disposition or export from Canada, the labor requirement, election, and attestation, and the most recent climate risk disclosure report production and disclosure date. And also, if you are claiming the refurbishment tax credit, you also have to provide details in respect of how the credit was calculated, considering it also involves the calculation of the development tax credit as well. And so to submit this additional information, again, you can use the T2 Attach-a-Doc service. And if you fail to do that within 24 hours, you have to get in touch with CRA to find out how to actually do that. So in terms of filing requirements, they're a little bit different than the Cleantech tax credit, where it has to be submitted by the filing due date, which is 6 months after the fiscal year end. And that said, if you do have a tax year ending in 22, 23, or 24, you can claim this ITC by the later of December 31st, 2025, or 1 year after the filing due date. So basically for 22 tax years or 23 tax years, that deadline is extended a little bit, where you have a little bit longer to actually claim it. And if the claim is accepted as filed, you will be notified by your notice of assessment or reassessment if it's an amended claim. Of course, some claims may be selected for further review, where CRA can audit the claim and potentially refuse some of the expenses. There is also the notion of recapture in this program, where you have to involve basically tracking and accounting for your actual use of the captured CO2. I imagine also how much CO2 you end up capturing. And then depending on that, you may have to repay credit amounts you have already received if the actual eligible use percentage is lower than the projected eligible use percentage. And if you disposed of the concerned property or exported it out of Canada. Now, for example, because the project has to involve at least 10% of eligible use, and that the calculation of the tax credit involves the percentage of the captured carbon that's destined for an eligible use, this could either reduce the amount of tax credits you get because your percent eligible use is actually smaller than you thought, or it could lead to the tax credit being completely refused if you fall under that 10% bar for the eligible use. So that is it for the CCUS tax credit. Now to get on to some closing remarks. So basically the program is very, very new, and the CRA is still in the process of publishing further documentation related to each credit. So it's important to keep yourself informed of that and to regularly visit CRA's website to see what the updates may have been. And it's also important to know that CRA now has a dedicated team that will exclusively focus on assessing and reviewing these applications. And they do also have a dedicated phone line for inquiries related to these programs, with the number being right there. And they will work in hand with Natural Resources Canada, who has the mandate to conduct detailed evaluations of the CCUS project plans and also verify that the involved properties are actually qualifying CCUS properties. And also, it's important to note that recipients of the CCUS tax credit that expect to incur over 250 million in eligible expenditures will be required to produce a construction and completion knowledge sharing report and annual operations knowledge sharing reports. And these will be publicly available to Canadians. So depending on the scale of your project, your administrative requirements could be significantly larger. And also, it's important to understand that the enhanced tax credit rates for companies which meet the stated labor requirements were put in place to help spur the creation of good-paying, sustainable jobs across regions and sectors. In particular for this type of project, as this is certainly going to become more popular in the future, and they definitely want to make it a habit for people to sort of include these in their collective agreements so that they are covered by the same labor requirements as collective agreements. And also there is a technical guide that Natural Resources Canada has published to help people identify eligible Cleantech properties. And the link is right there in the presentation. Now, it is relatively lengthy, but I think that's a good thing because it means it includes a lot of information to help you establish whether the properties you're looking at are actually eligible to the Cleantech tax credit. So right now we'll move on to some questions and answers where you have to submit your questions in writing and then we will address them. So if anyone has any questions, feel free to share them.
Yeah, so I saw there were a few questions. So about Marshall's question just popped up on the screen. So Marshall is asking about how do companies calculate the labor cost if the employees are not covered under the collective agreement? So there's a few components to that question. So I just want to make sure everyone understands the tax credit is not a credit on the labor cost. It's really a credit based on the money you spend to acquire the equipment. The labor cost rule determines the rate at which the credit is being calculated, okay? So then if you are working under a collective agreement, you follow that collective agreement and then you meet the labor requirement. If you're not working under a collective agreement, then you need to show proof that you are attempting to be as fair as possible. And that, Marshall, is based on the worker's position, location, and years of experience. So it's all based on an hourly basis. So for each worker that is part of your project, for instance, to install the Cleantech equipment, if you're paying your worker $20 an hour, but you don't have any collective agreement, it's your responsibility to go and look for existing collective agreement for a similar job, similar location in Canada, similar type of seniority in the personnel, and see whether this hourly rate that you're paying that person is at least equal to the salary that you would find in a collective agreement that aligns as much as possible with what you're asking them to do. And that would be how you can justify that labor requirement is met. So that's for the wage. And then for the apprentice, it's much more simple because it's just on an hourly basis. So you just need to calculate mathematically, if you are working with apprentice, how much time they're spending on the project versus all of your man hours, and if you're meeting the 10% or not. And if you're not meeting the 10%, that means you're not meeting the labor requirements. I hope that answers your question. But it is important that whatever the labor cost that you have, that's not used to calculate your tax credit. It just determines the rate at which you can get the credit. The other question that I saw, Steve asked about what is a trust return. So earlier I said that for the clean technology tax credit, you can claim whether you are a corporation or a mutual fund trust. So these are two types of legal entities in Canada. A corporation would have to file a tax return called a T2. Similar to you as an individual, you submit a T1 when you do your personal tax. So a trust has to submit a trust return, which is called a T3. So it's just a different tax return that you submit because you are a different legal entity. So the T3 includes different tax forms than what a T2 would include because it's not the same legal requirement. But in both cases, you would have that line, that Schedule 31, that would allow you to claim the credit. And then there was a question. So Sahar asked about contacting, how do you contact NRC? So Nick showed on the last slide that there is the web page for CRA where you can access all of the information that we've put in. And then there's also the direct phone number. Now, there is a disclaimer on that page that says that when you contact Natural Resources Canada to ask guidance about whether the property that you are acquiring meets or not the requirement, NRC will only provide guidance, but whatever they tell you on the phone is not a proof that you will be eligible. The final determination on whether or not you can claim the credit is on the CRS side. So you will never get a written answer from NRC confirming that your project is eligible or your equipment is eligible. You will only receive guidance, and then it's up to you to make your own determination based on the information that you have. And then after that, CRA will do the assessment themselves. I don't know, Nick, right? Nick, go ahead.
Yeah, there is a question. How do you put it up on the screen here? Because I can answer it in written, but basically, Sahar, you're asking is if hydrogen produced from chlor-alkali electrolysis is qualified for the clean hydrogen ITC, right? There it is. So as of now, there's very, very little information available for the clean hydrogen ITC. So we wouldn't be able to say at this moment what types of processes they're targeting or really anything else. They have indicated that they will make this information available at some point, but for now, we don't really know much about that. And in the same way, is Canada open for new pathways to produce electricity, to produce hydrogen other than listed in one slide? So there isn't really, for the moment, that much information about the hydrogen portion. Again, it should become available relatively soon. They're rolling out the other portions of this program still. So the important thing is to check on the CRA website regularly to see when that information actually becomes available.
I would also add that remember that because the government issues their new proposal every April, usually when you have a new tax credit or new government program that opens, the first year is more of a test. So they will see based on those guidelines the volume of application that they receive. And if that credit is underutilized because it's too niche, they will most likely can review the requirements to see how they can broaden those. Or sometimes what we see happen as well is that the credit rates change in the future because maybe not enough companies have benefited from those programs. So right now, that's all the information that's publicly available, but it will most likely be requalified, redefined, and potentially maybe change in the future if they see that it's too niche and not enough companies can benefit from those incentives. Good. I think that covers all the questions that were asked. So like mentioned on the chat on the site, so every participant will receive a copy of that presentation. You have all the URLs as well that are included for you to access the government's website to get more clarification. And of course, if you have any more questions or if you need any help with the preparation of those applications, so don't hesitate to contact Leyton or Nick or myself, and we'll be able to assist you in any application that you have with those 2 credits. So I thank you everyone for attending the webinar, and I wish you a great afternoon.
Thanks, everyone.
Bye.
Have a good day.